It is Tuesday, February 19th. Hope you all had a great 3-day weekend. Today we're going to look at a changing of the guard that we've seen over the last 6 months in the market and what it might mean. The finance sector has sprung to life with a breakout working. We'll look at a lot of flags in individual stocks and KRE. We've got biotechs also breaking out, plus some stocks, and we'll finish with a look at Asia. All right, so we're going to start with a broad market overview to start the week, and my main index, of course, is the S&P 500. Note that next Thursday, or this coming Thursday in 2 days, I'm going to do a special covering the 200-day moving average and the S&P 500 and back testing that to see what we can learn. But if we look at this, we can see that there the S&P 500 reclaimed its 200-day moving average with another advance last week. And you can see the last time it broke below was there in early December. And that, of course, was en route to this very sharp decline into December 24th and a very sharp advance. And it's almost like you can cancel out this V. This V never happened. And you've just been moving sideways for a year. But we do know that the index is overextended. However, overextended, overbought, those are the most overused terms there are out there. The S&P 500 was overextended at 25.75. It was overextended at 26.75. It was overextended at 27.50. And again, it's overextended at 27.75. So the play here really was to play the short-term pullbacks. And as noted on this next chart that I'll show you, we had a little pennant there, and we were seeing relative strength in small caps last week. So that was kind of a tell there that we could have some more juice left in this advance. We are coming into a potential, resistance zone. But again, we had a resistance zone here in the 26.25 area. We had a key retracement in the 27.25 area. So there's a lot of momentum behind this move, and that's what's taking out, these potential resistance and retracement levels. And I think we just have to focus on the short-term advance right now. We'll get a pullback at some point probably, and that might be more of an opportunity than a threat. Now, for short term, we look at the candlestick charts, and there was the last signal we had on the S&P 500. We had a little pennant formation that formed within this uptrend, and then we got the pennant breakout. And then we had a little throwback to the breakout zone, and we moved to new highs for the year with the advance last week. So this uptrend is clearly in place with first support marked at 267, we'll call it. And then if we look at QQQ, it's been stuttering a little bit because it's just barely above that prior high. But, there's that December high. It's challenging, but it as well had a pennant breakout and then a little throwback to the breakout zone and another move higher. And I'd mark support there at 167 for QQQ. And then IWM was starting to outperform. As I noted in Chart Watchers over the weekend, IWM moved above 50. The RSI 14-day moved above 50 a day earlier than SPY, and it moved above 70 this week. And the SPY RSI indicator is yet to move above 70, so that's a sign of strong momentum. And then we look at the chart, we had a nice little 4-day pullback and then a breakout. And again, the pennant low there marks support. We'll call it 148. So the indicators that I've been watching to identify this short-term uptrend have been the percentage of stocks above the 20-day EMA. And that indicator remains strong for the 4 major indexes. So here on this chart, I've got that indicator for the S&P 500, S&P Mid-Cap 400, S&P Small Cap 600, and NASDAQ 100. And you can see on this chart here that the indicator moved above 70% in early January for all 4. All right, and it has largely remained above 70% for all 4. The only one to dip below 70% briefly was the small cap index there. And all four are currently above like 85%. So a lot of strength here. And until these start breaking below 70%, at least two of the four, then I think this short-term uptrend could extend. Yes, even further. So we've had a changing of the guard in the market over the last 6 months or so. And you can see that changing of the guard when you compare the momentum ETF from iShares to the minimum volatility ETF from iShares. And this is a great pair to identify what is working in the market. So you can see here in the top window, I've got the momentum factor ETF. In the middle window, I've got the minimum volatility ETF. And momentum is going to be your high-flying stocks, all right? The ones with the most volatility, the ones with the highest growth rates. And then your minimum volatility is going to be usually the lower growth stocks and the ones with less volatility, obviously minimum volatility or less momentum. Now, that doesn't mean they can't go up, and they are still a big portion of the overall market. But you can see here that, momentum was leading in 2017 and in 2018, all the way up until September. And then we had a change. You can see that momentum took a big hit from October to December and rebounded, but it's right back at the 200-day moving average. In contrast, if we look at the minimum volatility ETF, it also took a hit. But look at that recovery. It's already above that September high. It's hitting a 52-week high already. So these are the leading stocks in the S&P 500 from the minimum volatility ETF. And then you can use a ratio chart to compare the performance of the two. There you can see that. That's a verbose symbol there where I'm showing the name divided by the other name. But you can see that, momentum was leading up until June, started underperforming into September, and is continuing to underperform. Now, is that bearish for the market? Well, it does mean, the risk appetite, the animal spirits are not as strong when momentum stocks are lagging. But when the minimum volatility stocks are leading, like maybe healthcare, perhaps financials, I'm going to get into those in a little bit, but they're still part of the market. And if they're leading, that is pushing the broader market higher. So this next group I'm going to look at is from Invesco or PowerShares, and this is basically called factor-based investments or ETFs. And there you can see we've got 6 factors from low volatility to dividend yield. And I'm going to click on the momentum. And so I get all their momentum ETFs, and I'm going to click the S&P 500 momentum ETF, SPMO. And there's a link for the portfolio. So you can see the stocks that are in this portfolio, a heavy weighting in technology and consumer discretionary, even in healthcare. And then if you look at the top holdings, there you can see classic momentum names there with MasterCard, Amazon, and Microsoft. You wouldn't picture JP Morgan in there, but they are, or United Health Group, but they are. So I think it's based on a formula, obviously using momentum. And in contrast, we can scroll down this list and then we can look at the alternative to momentum, which would be minimum volatility. So I'm going to go to actually low volatility and click that ETF. And if you look at the portfolio, there you can see utilities are at the top. Real estate is at the top. So this is a completely different profile than the momentum ETF. And then if you look at the biggest holdings, you can see a lot of utilities there and Coca-Cola as well. So looking at these two ETFs on a chart, we've got the momentum ETF at the top, the low volatility in the middle, and then the ratio of the two down below. And there you can see that momentum was outperforming all the way until September, and it has been pretty much underperforming since October. And there is the low volatility ETF, and you can see it's hitting a new 52-week high, and that's leadership coming from utilities and REITs. All right, now we're going to turn to the finance sector and then look at some individual stocks that are showing some strength. And the finance sector really came to life on Friday. You can see it was the leading gainer with a 2.13% gain. And then we can see the laggards on Friday were REITs, communication services, and utilities. And the way I created this table was I have a chart list with all the sector SPDRs in it. And then I just clicked to view that as summary format. And I went intraday, which is basically one day. I could also choose end of day, and I would get these same results there. And you could even go 1 month, 1 week, or 3 months. So looking at that end of day, I was surprised to see finance come alive, and that prompted me to take a look at these charts. So this is a weekly chart for XLF, the finance SPDR, and it's been a laggard for some time now. It peaked there in January, formed that lower high in September when the S&P 500 was hitting a new high, and then broke to 52-week lows there in November and December. Now it had one of the bigger advances off those lows here, and then moved sideways to form what looks like a bull flag, and broke out of that bull flag last week. So finance was underperforming the week before and early last week. And then with that big surge on Friday, it closed above the flag high there. So it moved flat for 3 weeks, you can see right there, and then closed above and is challenging that 40-week moving average. So all of a sudden, finance is looking like it wants to come to life here. The indicator window shows RSI 26 week. Like, why are you using 26 weeks? Well, 26 weeks is half of a year, 6 months, and it gives you an idea of 6-month momentum. And RSI, the cup is either half full or half empty. And it's half full when it's above 50, like it was here for over a year. And it's half empty when it is below 50, like it was for most of October, November, and December. But we can see here that it has just moved back above 50 last week. So the finance sector could be poised to move higher. Now, this is a pretty highly correlated sector, and that means most of the stocks in the sector are highly correlated to each other. They kind of all move in the same direction because, let's face it, the banking business is the banking business. It's not like software where you have a wide array of software services from niche to, the big CRM companies like Salesforce.com. But if we look at Bank of America in these stocks, we can see big surges, flags, pennants, or wedges forming, and breakouts of these flags, pennants, or wedges. And what these patterns are, they're short-term bullish continuation patterns. What you get is a big surge, and then you have a pullback. And after a big surge, you're entitled to a pullback. And, Bank of America was lagging here because the market was moving higher, but it was pulling back. But then it got that surge last week to get back above the 200-day, and I think it has broken out of this pennant wedge type formation and is poised to continue higher, and I would mark support there at 28 and reevaluate on a close below that level. Next up, we have Citigroup, and again, you can see similar price action. It's not exact, but it is similar. You've got the big surge, and then you have kind of a consolidation, and then we get the breakout here of the consolidation. So Citigroup looks like it wants to move higher as well. Moving on to the next one, we have Goldman Sachs. That's also a big part of the broker-dealer iShares. And you can see Goldman had a bit of a deeper pullback, if you will. It was underperforming there for a few weeks. But here's a gap, and it's kind of holding this gap because it firmed around 190 and got that surge on Friday. So it's not a picture-perfect flag or wedge or pennant, and we're not going to get picture-perfect patterns. But if you look at the essence of what's happening here is you've got a big surge, you've got a pullback, and then it looks like you're trying to break out and continue higher. Now, the one thing that these things have against them, these banking stocks, is that, they're below the falling 200-day moving average, most of them, and they're not leaders. The real leaders out there are the ones that hit 52-week highs in January and February, or the ones that are above their rising 200-day moving averages. So, finance is still a bit iffy. I think there are other plays that are better out there. Next up is JP Morgan, and look at this breakout. It looked like it was heading down after that 2-day decline, but it firmed, and then it got a breakout out of that kind of pennant. See, you can see that drawing these lines, they don't always match up, and you get failed breakdowns, and could be a failed breakout, but right now the breakout is there until it is proven otherwise, and I would suggest you need to close below 102 to reevaluate that breakout. And finally, Morgan Stanley, which I think is the weakest of these ETFs, or stocks, because it is well below the 200-day moving average. And look at that decline it had here after the gap. It had a gap up, then a gap down, and then it fell back. So the problem with Morgan Stanley is it is showing some relative weakness, but they do kind of move together. So, maybe this is some sort of a wedge thingy here. And if you get a breakout at 43, that would be bullish. Here's the broker-dealer iShares, which is, of course, related to the finance sector, because you've got Goldman and Morgan and Schwab and Ameritrade and E-Trade Financial in this group. And, there's the big surge, just like the rest of them. And you can see that IAI is still in that flag-like consolidation. It had a nice, move up last week, but we need a bit of a follow through here to get a breakout and a continuation higher. The other one that I want to show you is the regional bank SPDR. So here is KRE, the regional bank SPDR, and it had a big surge. And then you can see it stalled for 2 weeks there and then moved higher again over the last 2 weeks. So in that regard, it's leading XLF and IAI because it's been moving higher for 2 weeks. And you can see it's on the verge of taking out that December high there with a move this week. So it's just below that falling 40-week moving average. Is it a leader? No, it's not a leader. There are other leaders out there. I'll get to some of those later. And in the indicator window, I've got 26-week RSI, and I showed some moves above and below 50. It's not a perfect trend following indicator. There is no such thing as the perfect indicator. But you can see that, you had a move above 50 there in April, a move below 50 the next month, and then a move above 50 and below. So, you had some whipsaws, and then you got the good signal. And that's kind of the way trend following works. It says one good trend pays for them all. And then we got a little bit of a pullback there in September, and then we got another whipsaw. But look at the advance after that whipsaw. And then we got a pretty good signal there in September, and now RSI has just moved above 50. Will it be a whipsaw? I have no idea. That's the thing about these signals. You never know which one's going to be a whipsaw and which one's going to take hold. I will note that KRE is quite overextended after this big advance, so the ideal opportunity would be for a pullback to materialize. It would be playable. So looking at some individual stocks in the regional bank SPDR, Fifth Third Banking Corp, similar setup here, big surge. We got the falling flag working, and then we got this initial pop on Friday. It looks like we're going to get a flag breakout and a continuation higher. And then you can see if you close below the low from last week, you have to reevaluate. Then we have Principal Financial Group, PFG, and you can see a similar situation here where they have the big surge and then a choppy pullback. But look at the breakout there and breaking above that December high. Head and Shoulders aficionados might mark that pattern there with an inverse Head and Shoulders pattern. But again, is this one of the leaders? Well, no, it's still below its 200-day moving average. The leaders are above their rising 200-day moving averages. But this could become a leader. Regions Financial, similar situation, the big surge, the flat consolidation, and the breakout. And yes, I am taking a fielder's choice, and I'm just going to ignore that spike there and call this a breakout. And U.S. Bancorp, man, look at that advance, 43 to 51, kind of a choppy consolidation. So it looks like kind of a flag and watching for the breakout. Now we're going to move to biotech and look at the two biotech ETFs as well as some individual stocks. And IBB here got a big move last week, up 4%, and it broke out of its consolidation. Similar situation, but you can see that it is stronger than finance, and for two reasons. First of all, that 40-week moving average is slightly rising, whereas the finance 40-week moving average is falling. And second, you can see a break above that 40-week moving average for IBB. So it could be considered one of the potential leaders here. And look at that big surge. Then you had basically a 3 to 4 week consolidation in a tight range, and we broke out of that range last week. So if you move below, say 106, then you would have to reevaluate that breakout there. And then in the indicator window, you can see RSI moving just above 50 there. The next one is XBI, and I've made the chart for RSI a little bit bigger on this window here. You can see here that I'll go ahead, if you want to, you can click on that chart and then you'll see the Sharp Charts workbench. And what I did was I added RSI as an indicator. I've got 26 weeks for 6 months. And instead of auto for the height, I changed the height to 1. So that makes the height of the indicator window equal to the height of the price window. So you can get more detail in your indicator by getting that window bigger. So if we see here, first looking at the price, because it's the most important part here on the chart, but look at that, we're breaking above that December high with a move yesterday. So XBI surged, stalled for a few weeks, and continued higher last week like IBB. It's still below the 40-week moving average, but the 40-week has a slight upturn from last week. And there you can see RSI moving above 50 for the first time since October. So quite a few months below 50. But, you know, look at the trend you caught here if you've been using RSI. You caught a pretty good uptrend there. You're going to get whipsaws. That's just all part of the game. You know, use your trend following indicators to kind of indicate, and then you look for patterns that match up with the trend that you're seeing on the chart. So if you have an uptrend you're seeing on the chart, look for bullish patterns. If you have a downtrend on the chart, I would just stay on the sidelines, because shorting the market, as we've seen from this face-ripping rally that we've had over the last 2 months, all the bears have had their faces ripped off. Shorting the market is usually not a good idea. So looking at some stocks in the biotech ETF, and keep in mind, these are going to be volatile stocks with lots of risk, and several of them are reporting earnings fairly soon. For example, you can see Ionis Pharmaceuticals reports on February 27th. But the pattern is bullish overall. You're definitely in an uptrend. You have kind of a cup with a handle and breaking out of that handle as I speak. And then if we look at Amarin. Now, Amarin is an interesting one because you can see, look at that, 3 to 20 or whatever. So clearly this is not for the faint at heart, because it's a very risky biotech. And you can see earnings are on the 26th of February. High volatility equals high risk. But if you look at the patterns at work here, you can see the first breakout surge, and then we had a correction, and it looks like it's breaking out of that correction here. High risk. But if you look at the patterns at work here, you can see the first breakout surge, and then we had a correction, and it looks like it's breaking out of that correction here. Next up is Ascendis Pharmaceuticals, and we can see that it had a big surge and a breakout. And this is kind of a classic pattern I like to use. After a big move, you get a pullback. It's called a throwback. And you have kind of a zone here that was a prior resistance zone that turns into a support zone. So what happens is you break out and then you throw back to that zone that turns from resistance to support. And now we're turning back up off support here. Yeah, I wish I'd caught it a few days earlier, but I didn't. Horizon Pharmaceuticals, this one's been on my list already, and you can see it's a real leader because it's been zigzagging higher with higher highs and higher lows the last 6 months, whereas the market had the big V bottom in December and the big advance. This one's just been zigzagging higher, and the latest pattern is like a pennant within an uptrend, so it looks like a bullish continuation pattern. And finally, Vertex Pharmaceuticals, VRTX, you can see a big surge, and that is a 52-week high. So clearly you're in an uptrend when you're hitting a 52-week high. You're above the rising 200-day moving average there. This pattern is not picture perfect. The lines don't match up to make a nice, flag with parallel lines, but the essence is there. You have a big surge, you have a pullback, and it looks like we're on the verge of a breakout. So now we're going to turn to Asia because China is getting a breakout, and I first featured China on Valentine's Day, February 14th, as I saw some movements in the ETFs after the Lunar New Year. And then on Twitter today, I saw a tweet from David Ingalls, who's the anchor of Bloomberg in Hong Kong, and he notes that every single member of the CSI 300, the Chinese index, closed higher on Monday. This was before the close, but he updated that. All 300 stocks closed higher on Monday. How's that for strong breath? So let's look at the ETFs. So the first ETF is FXI, the China Large Cap iShares ETF. And you can see it found support here in that 38 area, and that was in the 50 to 62% retracement zone. You have a couple of lows to work with there, and then a break above the intermittent high and a break above the 40-week moving average. And just to show, I've got the index below in the second window and the currency, the yuan ETF, in the other window. Now, the other ETF to watch out for is this is the CSI 300 A-shares ETF, which is based on the index I just showed you from the tweet. And you can see here that it is even stronger because look at that breakout there. It broke out with a big surge last week. It's up again today. It's above the 40-week moving average. So this is a big boost for Asia to see China turning the corner and breaking out. Two others to look at here. We have the Vietnam ETF with a double bottom there and a break above double bottom resistance and above the 40-week moving average. And then we have the South Korean KOSPI index and the ETF. So the KOSPI is in the lower window, and you can see it broke out 4 weeks ago, and it's just below that falling 40-week moving average. So we need to get a little breakout to continue that advance. And if you look at the ETF, you can see that it found support twice there in that 56 area, and then got the breakout there above that intermittent high. So it's kind of stalling just around that 40-week moving average. So be looking for the direction of the next move there. And remember to stay on the right side of the trend.